hint to everyone. I forgot to mention to turn your mobiles on to silent, please. But do please send us questions now for our next speaker, Eugene McAuley of the ESB. Eugene is a specialist in modelling energy markets and market design. It's been 26-year career experience of power stations, IT market design, and in particular, particularly given the recent history with the oil price. I don't know how many people have hedged their oil price in the room, I'm not going to ask, but there's been a significant drop, and he's looking at forecasting electricity prices and production volumes, and looks at modelling the GB and Irish markets, and is going to chat to us a little bit about how you're going to model into the future. Over to you, Eugene.
Thank you. I suppose firstly just to welcome you all on behalf of Electric Ireland, who are one of the main sponsors of the event. What I'm hoping to do over the next 20 minutes or so is to go through a few elements of the electricity market and the commodity market, and hopefully it'll be of interest for you. The first thing is how electricity prices are determined, how the pool works very quickly, very high level, the commodity prices, and a little bit around the impact of renewables and the impact it's having on the system and on the price of electricity. So how are electricity prices determined? I suppose the first thing to be clear about is that a lot of what you pay for your electricity is not around the market price of electricity. It's around regulated charges that are in the market, your transmission use of system charges, distribution use of system charges, PSO charges. There's a capacity element, and for sort of business tariff customers, only 40% of their demand of the price of electricity is actually made up from the wholesale price of electricity. So if the wholesale price of electricity falls by 10%, you're only going to see a 4% reduction in the price that you pay. Now for the LEU customers, for the larger customers, it's a bigger percentage, it's about 55%. But that there is a lot of what you pay for electricity that isn't determined by international commodity prices, isn't determined by the wind on the system, is determined by much more regulated type costs. So looking now at sort of the wholesale end of the market and how the wholesale market works, I suppose in some ways to call it a market is a bit nice to it. It is actually, it's a regulated set of trading arrangements. Every generator must bid into the pool. Now those generators there's coal plant, there's gas plant, there's still heavy fuel oil plant, they're north and south of the border, there's the interconnector, there's wind, there's some hydro, and there's pump storage. Their bids into the pool are regulated. They can only bid the opportunity cost. And there's a market monitoring unit whose job is to make sure that every generator bids their costs. And the costs, because it's defined as opportunity costs, it's the price of gas in the market or the price of coal in the market, plus any sort of variable maintenance costs. So it's a very regulated set of bids that the generators put in. They're not allowed to take account of contracts they might have. They're not allowed to take account of other things. So it's very much based on their opportunity costs. Then I'll go to the next slide. I'll explain how the pool works a little bit. Then suppliers take the price that is paid in the pool. They have to add all the extra regulated costs onto the end of that, and they sell it to the end user, to customers, be they domestic customers or be they large business unit customers. So just one more slide quickly on how the pool works. The pool is very much, each generator bids in their prices, and this is a simple view of the stack on the pool. So you bid in your fuel costs, the carbon cost, your variable operating and maintenance costs. That's what you're allowed to bid in. Then these are stacked up in order of cost, and they look then at demand they have to meet. The two lines cross over. Any plant to the left of this is dispatched, so the cheaper plant is dispatched, the more expensive plant isn't dispatched, and everybody gets paid the price of the most expensive plant that is running on the system. That's the pool design, that's how it works. So the most expensive plant on the system isn't making any margin out of the pool. He's bidding in his opportunity costs, he's recovering his opportunity costs. the cheaper plant on the system are actually making a bit of a margin out of the pool. I suppose some of you may know a bit more about how the pool works, be a bit more in detail on it, and there is sort of three elements to the costs that a generator can bid in. The first element is their start cost, so it's the cost from going with the unit cold, sitting unused, to getting it up to full speed and just when it synchronises onto the system. And that can be quite a high cost if a unit has been sitting off for a few days and is cold, and it's, say, a conventional unit like a coal plant, that can take quite a bit of time and there's quite a bit of fuel burnt in actually getting up to speed. Then there's the sort of the ticking over cost, the cost of just keeping the system, keeping the unit on the bars for each hour. So just keeping it running at 3,000 revs and synchronized. And then there's what's called the incremental cost, of the cost of loading, the cost of each extra megawatt on the system. And the cost of the loading is the easier one for the market to look at, and that is what sets the shadow price, as it's called, which is the orange bar at the bottom of the graph. But the unit also must recover its start costs and its no-load costs. And there's an algorithm determined to how they recover those costs. And that's recovered in the blue line, which is called uplift. Now, this algorithm was changed recently by the regulator. He changed how the uplift is calculated and smears it slightly differently. So for some of you, you might notice that it's actually tending to push up nighttime prices a little bit and pull down daytime prices. So the regulator has changed that and has the right to change that as he goes along. So just on a percentage basis, so this is going back from July 2012 up to the end, or the end of September in 2014, most of the costs that you see in the system, most of the element of the price is made up of the loading, but the percentage of uplift is actually growing slightly bigger over time, and wind and things like that will cause that to grow slightly bigger, so as more plants start and stop and have to recover the start and stop costs because of wind and the fact that wind sometimes blows and sometimes doesn't, causes that to change. Now, I suppose we've done a lot of analysis on what sets the price, the wholesale price of electricity. One of my jobs is to try and forecast the wholesale price of electricity, and we have sort of a motto that all models are wrong, but some are useful, because guarantee the one thing I won't do is actually forecast the correct price of electricity. But what we do know is that the price of electricity is correlated to gas prices. So we have seen that over time, and even over, this goes back as far as January 2008, up to date, that as gas prices go up, electricity prices goes up. As gas prices go down, electricity prices go down. Now we see that, and we see the carbon is involved in that as well. So it's gas and carbon are the two main elements that will set the wholesale price of electricity. Now we expect that as more wind comes on the system, that this relationship may weaken somewhat. But at the moment, this is what we're seeing, and it's very much there is a mathematical relationship there. Now, this is monthly average prices that you're looking at here, and if you go to a daily basis, what you'll see is that the electricity price is a lot more volatile than the gas price on a daily basis. And that's because you'll get weather coming into that, you'll get availability of key plant coming into that, you'll get other elements coming in that don't affect the gas market. The gas market gives you one price per day, the electricity market changes the price in every half hour. So you will see that the electricity prices on a daily basis are much more volatile than gas prices, but on a monthly average basis there is a good relationship between them. The other element is that even though the market in GB is a very, very different market, they don't have a pool, they have a bilateral market. People enter into contracts as they see fit. There's no bidding code of practice in GB, you don't have to bid opportunity costs. What we do see is that there is a good correlation between Irish prices and GB prices. So while the market design probably drives in some of the correlation, it's there for GB as well, which so it's there on the fundamental underlying physics of the market. That brings me to commodity prices. I'm really only going to look at gas prices because gas prices are the critical one. And I suppose there was headlines during the year about gas prices falling 40%. And yes, the spot gas price did fall 40%, but the forward prices didn't fall as much. And if you're looking at selling to a customer, you want to hedge your risk, you want to manage your risk, and you do that by buying electricity forward. So you're buying you're looking at the forward price of gas, not the spot price of gas. So if you look at the graph, the red line is the spot price of gas over the last 2 years. So you'll see that in sort of March, April 2013, when there was issues with the gas, and there was a bit of a cold snap. The gas prices went very, very high, and then came back down, and then but that the forwards price didn't follow that up at all. It really went quite smoothly. And then you see during 2014 that at the start of the year, the spot price fell away very, very drastically, and fell away. It was almost 40% of a drop. But that the forward price was following it down much more slowly. Now the gas price, as you see, the inflection point on the curve was when the Malaysian's airline plane was shot down over the Ukraine. That just caused that inflection and caused gas prices to go back up again. And what you're seeing is that forward prices and spot prices are a little bit more volatile at the start of this year, but in general, you know, you'll see a large volatility in spot prices, and when that volatility is on the downward side, it makes great headlines in the papers that gas prices have fallen 40%. You know, the papers haven't come back out to say the gas prices have gone back up. So, but that the forward price is the price on which tariffs are set and on which contracts are based. The next thing we did, it's a little bit of history, but I think it's very useful as well. It's around can you forecast the forward price of electricity based on the current spot price? So we looked at the GB market, and this is from January 2007 up to January 2013. This is the actual outturn of the monthly spot spread in the market, so the monthly spot profit that a gas power station was making in the market. And we're going, could you, looking at the forward prices and the various parts of this curve, forecast where the spot price is going to go? So we've added in these lines, and I'll bring them all up slowly. And what you'll notice is that as the spot price changes and the volatility in the spot price, you only see that reflected over the next month or two, really, of the forward price, and that the forward price is much, much less volatile. And the forward price, you know, if the spot price goes below a certain level, the forward price will be higher than it. If the spot price is higher, the forward price will go lower. So over time, what you're seeing here is you're seeing a £65 spread in the spot prices, but you're seeing about a £10 spread in the forward prices. So you're seeing that there is a lot less volatility, and just because prices go up today doesn't mean they're going to stay up next year. They do trend back to a level. I suppose just bringing it back to how this might be of interest to you, suppliers have various tariffs that are available. You know, if you want to take that volatility and believe that, you know, by taking that volatility it'll end up better for your company, the suppliers are offering pool price pass-through tariffs. If you don't want to take that volatility and you say, no, I need surety of the price of electricity is more important, then there's sort of standard tariffs and fixed price contracts. So it's really up to each individual company and the risk that they want to take to prices. And I'm not sure what suppliers offer exactly what tariffs out there, but that's this is the range. So you can go from being fully fixed to partially fixed to fully floating. Just to go on and have a look at renewable technology and its impact on the system. What we've seen over the last number of years is a big increase on the level of wind that's installed on the system. Last year, 18% of demand on the island of Ireland was met through renewable generation. Now, it's very good, it's low carbon, but it is increasing. It's increasing very, very quickly. We're forecasting a lot of extra wind to come onto the system this year. There's some subsidies that you have to get in the next 2 years to get the subsidies. So the wind is coming on very quickly. Just to sort of, and this graph meets the 2020 targets of having 40% of our demand met from renewable sources. But just to sort of say that, you know, the daytime peak in Ireland is about 5,500 megawatts. At night, we drop down to about 2,000 megawatts. So wind is becoming a much more bigger influencer on other plants running on the system. You know, EirGrid, who manage the national grid, are actually bringing in new services now, so that power stations who in the past would have run and just supplied megawatts onto the system will now get potentially more value from actually providing reserve onto the system, providing, you know, big lumps of spinning metal are needed on the system because wind is not great for faults. If there's faults on the system, wind doesn't respond and it gets EirGrid nervous. I've two graphs now. I personally think they're quite interesting. I hope you do as well. This is 2 actual weeks, a week in January and a week at the start of February this year. So I just pulled these 2 weeks. We do a lot of analysis of the system on a weekly basis to see what's running, what's not running, what plant are bidding in. And I suppose this graph surprised me when I saw it, and what's happened here surprised me when I saw it. If you look, I'll just stand away. If you look at that element of the graph there, that's about 6:30 on a Saturday morning. And at 6:30 on a Saturday morning, there was one conventional power station running on the system in Merritt. The rest of demand was being met by wind, or by peat plant, or by interconnectors, or by hydro. So that's at that moment, wind was meeting 66% of demand on the system. And you'll see then that later on in the week, as wind fell off, that other plants had to start. You'll see just as you're getting, this runs, from a Thursday to a Wednesday is the way is the way that we look at the week, because the timing that we get the data at. So over the weekend, the wind started to fall off, and on Monday, Tuesday, Wednesday, they had to start other plant, and that plant then must recover its start costs in the market. And then the next graph is it's about 2 weeks later, and what you're seeing is at the start of the week there was quite a lot of wind, but the wind fell off very, very quickly as the week went on. And now you're seeing a lot of plant coming on and starting on the system. And if you probably can't see it, but if you look at the slides afterwards on the Monday, which is the third peak in, if you look at that peak, what you're seeing is that actually over that time the Tarbert started. Tarbert is a heavy fuel oil power station in Kerry that I worked at years ago, but is no longer owned by ESB. Tarbert hasn't run very much over the last couple of years, but it started over that period due to the very low wind and due to other system conditions, and would have incurred a very large start costs. Now that actually, there's a secondary reason, I suppose, for Tarbert starting, is that heavy fuel oil prices, as we're all aware, have come down so much over the last year and the last couple of months, is that Tarbert is actually getting back into Merritt. I suppose that finishes all I wanted to say. Just to say that there is an Electric Ireland stand at the back of the room, and there's one outside beside the tea and coffee. If you want to come and talk to Electric Ireland about everything or anything, I'll be here myself until after the tea break, or longer if needed. And just to mention, that we, Electric Ireland, do have services in the energy efficiency obligation area and the demand side area. Thank you.